today's topic is actually what issues should you consider before you retire, and I think we just want to touch upon a certain amount of those, and we'll make this available publicly to our audience with a link below in the description.
And shout out really quick to the authors of this. This is from a tool called FP Pathfinder, which is, in my opinion, a terrific financial planning tool. They publish interactive checklists. They update them for tax changes, and they really make a bunch of thoughtful checklists around a lot of financial planning issues. So if you're a planner out there or an interested self-guided retiring person or investor or planner, get in there. Check out fppathfinder.com. They're great.
And so I marked here with you before this call some of the ones we wanted to talk about. How about we start with the first one? Are you retiring early? And I think this is super important and it just affects a bunch of other stuff too. But if you're retiring early, what do you need to consider?
We don't have that much time, but there's a lot. I think the two that are going to be kind of lumped into this same one are the lack of Social Security is a really key one. So Social Security, in my opinion, is a pretty generous system that supports, I mean, we know for a fact that it supports an incredible amount of seniors who are retired in the US at present, and should be a massive part of almost everyone's retirement plan, especially if you think you're going to live into your 60s, 70s, 80s. Social Security is incredibly important. So not having that when you retire early, when I'm thinking about people who are retiring early, I'm thinking about that bridge between, okay, let's say you're 51 and your full retirement age for Social Security is 67. How are we going to cover that income bridge? That's a really key consideration that deserves some analysis, in my opinion.
The way I think about it is they made a lot of money. They're not really employable anymore because their skill set was only active for a couple of years. I mean, think about athletes or software developers who have no desire to be in management. And so they kind of get pushed out because software developers is, a job that, most employers want young folks in. But anyway, so I think, if you have made it, if you're lucky enough to have made a lot of money, you just need to plan ahead for that gap between, I would say, full retirement and where you are currently now. And so one of the things you can do here is access your 401k, but this is the access again starts when you're 55 or later. So there might be a couple of years before that, if you retire earlier, where you will need to find other sources of income or other sources of assets to liquidate to fund those years.
I love this one. This is an under-discussed and underutilized planning tool. I've seen it referred to online as the rule of 55. But if you retire at age, like we under current law, think of 401ks and IRAs as really penalty-free accessible at that key age of 59 and a half, which is such a random number. But There's an exception to this. There's a couple exceptions. One is Rule 72T, which isn't on here, which we'll leave for another discussion. But the Rule of 55 is a really great one that says if you are retiring from the job where you have your 401k, you can tap that 401k between ages 55 and 59 and a half penalty free, which is for certain people could be a massive difference maker, right? That penalty 10% on withdrawals is really onerous if that's your big nest egg that you need to tap.
Sure, you're considering all the expenses, but one of the biggest expenses between now and I would say 65 until you're 65 is essentially Medicare or health insurance, right? So you need to find a way of paying up for health insurance between now and the age of 65 when Medicare hits. When Medicare becomes available to you, of course, take advantage of it, apply immediately and get it, right? But in the meantime, like, how are you going to fund health insurance? And so I would say there are solutions to that. One of them is, contributing to an HSA and using the HSA funds there to fund the premiums. How do you handle that?
Ooh, I don't think you can actually use an HSA for medical premiums. Do you?
I know. I think you can. Maybe
Really?
let's look here quickly. Oh, that's right. Generally, it says here, generally you can't. But my understanding was that you could if it's unless the premiums are for long-term care insurance, healthcare continuation coverage, such as Cobra. And so that's kind of like so Cobra. How long does Cobra last you for?
I want to say like 6 or 12 months. I'm not sure.
It also says here Medicare and other healthcare coverage if you are 65 or older.
Okay.
So other than premiums for Medicare supplemental policy such as Medigap. So if you retire, let's say at if you're 64 or 63, I think if Cobra covers what 3 years or 18 months.
I
It
think
depends. I think it
yeah,
depends.
I'm not sure.
Depends what kind of how you exited from the company.
I think so too. I think so too. These two pieces right here. This is the least fun, the most annoying, the most expensive piece of early retirement, in my opinion, is health insurance. So
Yeah.
in Arizona specifically, I just reviewed this with a client. He's in his 40s, has a wife and 3 children that need health coverage. He's considering early retirement. And we went on healthcare.gov and looked up premiums. And for a silver or a gold plan, it's between $17,000 and $30,000 a year in premiums
That's
alone
insane.
before you're getting any
Crazy.
actual coverage, right?
Yeah.
Really, really wild. So this is
Yeah.
one that requires some research, some attention, and also just some sensitivity testing in your actual financial plan to say, okay, let's assume that these are, inflating heavily, right? Let's assume next year is worse than last year, which is the case from 2020 to 2021 for sure. Costs on healthcare plans in the marketplace most definitely rose pretty fast.
If you have any stock options, grants, or restricted stock units, what things would you look at if a client asks you, hey, I'm thinking about retiring. I have ISOs, non-qualified stock options. I have RSUs. What would you do next?
This makes me think of how clever employers are at retaining key employees, right? Like they keep this going, and the way that they do that is generally, in my opinion, through vesting schedules, where the value might accrue on the latter half of a grant, right? So you got a grant in 2019, it's now 2021. It doesn't finish out until 2023, and maybe the stock prices increase, so the value really accrues on the second half of that. And by the way, they're going to give you a refresher grant that's also generous. Ultimately, it's all just part of your annual comp, right? And has a variable amount to it. But that's the first one is just your vesting schedule. Be very aware of what kind of value you're leaving on the table and whether that makes a difference to your plan. The second one is reading your actual grant documents and understanding what retirement or separation from employment means. Like, read it all the way. If you don't understand, hire an attorney who can help you talk through what that means. That's really, really crucial. And then the third thing is that with incentive stock options specifically, there is, under present law, an IRS rule that incentive stock option treatment, which we know is better treatment, it's kind of a nicer treatment than non-qualified stock options, that has a 90-day window post-separation, after which those options are going to become non-qualified. So there's a time limit post-separation from employment in which you have to exercise those ISOs or lose ISO treatment. So that can be a ton of value for certain people.
Yeah, and remember always I would say the rule of January, which is January is usually typically the best month, or the earlier the year is usually typically the best month to exercise ISOs. It gives you a lot of time to pay taxes because if you exercise in January, first of all, if you exercise ISO, you will likely have to review your AMT, alternative minimum tax, to make sure that calculation, whatever the number it gives you, to be aware of. Then you're going to pay that tax. If you have an AMT tax, you're going to pay that tax in April 15th at the latest. And so if you exercise in January of, let's say, 2021, that tax is paid April 15th on the 2022. And so exercising in January will give you the most time before you pay taxes. Now, if you exercise in December of 2021, you'll have just a couple of months to do that. And on top of that, you won't be able to sell long term until December 2022, which is after you pay taxes. You're going to have to come up with the money somehow. I think the most important thing, as you said, is like be aware of what you're leaving on the table. And the second thing is that ISO rule. Apart from that, there isn't much to think about, in my opinion.
Actually, I think the law would call a 401k or a 403b. Those are technically deferred compensation plans. But I think that this specific checklist item is referring to 409A non-qualified deferred comp plans. If that is meaningless to you, I understand. They're not for everybody. Not everyone has them. I've seen them referred to as top hat plans before because they kind of are a top hat that sits on top of your other retirement plan and like a general employee benefit plan. But a 409A allows you to take some of your salary or bonus or stock comp and simply defer it for usually a set period of time, a minimum set period of time, to where it's not taxable to you in the year in which you defer it. So if you've got a $300,000 salary and you say, hey, my income's going to be going down because I'm going to be retiring soon, you could do a deferred comp plan, put $100,000. They have often very generous limits on how much you can put in. Put in $100,000, reduce your taxable income to $200,000, and then defer that $100,000 as $20,000 a year over the next 5 years post-retirement, right? So this can be really useful for what I would call chunking. Chunking just means taking income and chunking it into different tax years strategically. These are really useful. As this is like similar to the stock option question, you need to think about the time frame of withdrawal along with your RMDs, which we'll get to in a second, along with Social Security, and look on a forward-looking basis of what your income taxes are going to look like, and try to use the rules of the deferred compensation plan to be as strategic as you can with when that income is going to be paid to you. These are very useful, often very flexible. They come with a little more complexity because they're usually only offered to senior employees and executives and that type of thing, but very useful. But you got to be strategic and think ahead.
When you said, let's project forward kind of your income and figure out what your taxes, I think that's key, pre-retirement. And the reason why you want to do that is because you actually want to see if in your plan before you retire, if you have a dip of income, you want to take advantage there and convert potentially some of your 401k or IRA into Roth accounts. And by doing so, that creates income in the year, and so it pushes up your taxes. But if you happen to have that dip, you can take advantage and increase your income in a year where income is low, and then basically, in other words, you're taking off income in the future where you might have a higher income. So essentially, you're smoothing out the income over years. And so I think that is what the next issue comes up or talks about. Do you expect to have large required minimum distributions? If you do, then you would want to look at that and make sure that in the years that you have less income, you're probably doing some conversions.
Who has large required minimum distributions, and how do you figure out what they are?
But these rules have been changed in the last year, right? But you at some point, you will have to take out money from your 401k/IRA. The required minimum distributions is basically taking the balance as of, I think it's December 31st of those accounts, and dividing that by your expected lifespan of that year. And then, so let's say your expected lifespan at the age of 70 is, another 16 years. So you divide the balance of all those accounts over 16. And so that's your required minimum distribution for the next year. That required minimum distribution is going to be likely counted as income for federal tax purposes. It's just income. It's already paid Social Security taxes. So all you have to pay is income taxes. But if those are pretty high, if your balance of the IRA and 401k is pretty high, then you'll probably be taxed at the highest bracket. And so what the idea here is to smooth your income over for your entire lifespan. So I think the right idea here is to convert what needs to be converted so that over your lifespan you have equal income every year, unless taxes are going to go up. If taxes are going to go up, you're going to have to, the equation probably will require you to have more income in the years that tax rates are lower.
This is a consideration for people who are under current law approaching age 72. 72 is when RMDs begin. That's subject to change, of course, up or down, and is a critical planning point that you need to be looking at for retirement income and retirement taxation planning. The pre-RMD Roth conversion is a super powerful tool. If you've never looked into this, ask us, Google it. It's pretty awesome. It can save you a ton of taxes in retirement.